Let's talk about sales and how to record them and what goes into accounting for sales. Accounting for merchandise sales, the company has to think about sales discounts, has to think about sales returns and allowances, and those are things that we're going to get into shortly in order to get to gross profit. They have to think about people bringing stuff back, they have to think about people returning stuff, and we're going to calculate all of that into our sales amount to get to our gross profit. Gross profit is sales minus cost of goods sold. We're going to get into all of that in a little bit. Sale of merchandise involves two separate items, two separate parts. The first part is the revenue that the company gets for selling whatever it is they're selling to the customer. And then the second part is recognizing the cost of that merchandise. They don't get it for nothing. The store has to buy it and then resell it. So the cost of that is the cost of goods sold. If I sell you something for $1, I didn't pay $1 for it, or I'm not making any money on it. Here's an example of the journal entries for the sale of merchandise. On November 3rd, Z-Mart sold $2,400 worth of merchandise on credit. On credit means that they sent a bill for it. They didn't get paid for it right away. The merchandise had a cost basis to Z-Mart of $1,600. That means that it cost Z-Mart $1,600. They had to pay that in order to buy that stuff and have it in their store. So the first journal entry is going to be a debit to accounts receivable. Think back to the accounting equation. Think back to the journal entries in the transaction analysis that you did in the very first modules. An asset is increased on the debit side. So we're increasing our accounts receivable, and instead of calling it revenue now, we're calling it sales, because sales revenue refers to work that's actually done, and sales refers to selling some goods, selling something other than work to someone else. So you're going to credit sales because that's an equity account, just like revenue was. The second part of it that the company has to record is what the merchandise cost. Cost of goods sold is an expense to the company. Cost of goods sold is what that merchandise cost Z-Mart, and they tell you it was $1,600. The credit is a decrease in an asset account called merchandise inventory. Merchandise inventory, if you recall, is the stuff that the company owns for resale. We're reducing that account to show that that amount of inventory has been sold, has gone out of the store. Every sale will have these two journal entries. Sales discounts are discounts that a seller gives to a buyer for paying within a certain period. Sellers offer discounts so they can get their money more quickly. This example shows the journal entries for Z-Mart. The cost of goods sold entry isn't shown because it doesn't change no matter when the customer pays. The sale was made on the 12th, so Z-Mart debits cash and credits accounts receivable for the $1,000. If the customer pays within the discount period, Z-Mart records a debit to cash for the amount of the bill less the discount. They then record a debit to sales discounts for the amount of the discount and a credit to accounts receivable for the entire amount. The journal entries are shown here and refer back to the previous slide. Sales returns and allowances are recorded for merchandise that is returned or discounted because of defects. Here are the journal entries. Z-Mart sold merchandise for $2,400 that cost $1,600. If a customer returns $800 of that merchandise that had a cost to Z-Mart of $600, these journal entries would have to be recorded. Debit sales returns and allowances for the sale price, the $800, and credit accounts receivable. Then we have to account for the cost of the merchandise that's being returned. Debit merchandise inventory because the stuff is going back in the store to be resold. Credit cost of goods sold, both for $600, the cost of the merchandise. A sales allowance differs in that the customer doesn't actually return the stuff. Maybe it's the wrong color, but they decide to keep it if they can get a lower price. This should be recorded by debiting sales returns and allowances and crediting accounts receivable. But the cost of goods sold and merchandise inventory accounts aren't adjusted.